Hello and welcome to this live programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts. My name's Richard Lander of Citywire, and today we're focusing on China. I'm talking to Linda Lin, and Linda is co-manager of the Baillie Gifford China Growth Trust. So Linda, welcome. Thank you for joining us. The title of this webinar is A Tale of Two Stories. So if you could briefly tell us what those two stories are and which one you prefer to follow.
Thank you. It's great to be here. I think the phase of A Tale of Two Stories really reflects what the people seeing China today. So one story we often see on the Western media, it's about slagging property market and weak consumer sentiment, and also rising tension between US and China. So if we look at that story, it paints a very negative picture of a slowing economy, and also it's really a hard market to invest. And also we do understand, I think in last few years, China equity market has been underperforming the global market for quite some time. But the other story, the second story, is the story we see on ground as investor every day. It's a story about transformation. So that's about China leading the global manufacturing, accounting about a third of the total. And that's a story about the global leaders in EV, in solar panel, in clean energy, and in artificial intelligence. So actually, in 2024, China equity market is one of the best performing market globally. And our trust in 12 months to March 2025 generated around 40% of the return for our shareholders. But most of the stories are real. But for some long-term growth investor like us, we think the second story is more important. That's a story about innovation and invention, and also that's where the future growth is coming from.
Right, okay. So as you mentioned, it's been a good year for the China market and an even better year for the trust. You said a rise of nearly 40%, both in NAV and share price terms. Now that obviously after a prolonged period of depression for both the market and the trust. So is this bounce a sign of real lasting recovery, or is it more of a tactical rally for the China market?
Right. I believe it's more than a short-term bounce. I see this as a long-term sustainable recovery of Chinese equity market. Let me break down here for several reasons. I think firstly, you probably see since September last year, Beijing has already taken aggressive steps to drive the economy growth. And actually, that's a very aggressive attitude I haven't seen from the global financial crisis. So they're taking this very seriously. They want growth back to China's economy. And secondly, I think this is a very important message. It's about the government attitude to support the private companies in China. I'm sure you read the news about President Xi met a group of very important entrepreneurs in China in January this year, including DeepSeek's founder and also the founder of Alibaba, Jack Ma. So this is a very clear message sending to the global market. They are going to support the private company, which are the true growth driver of the China economy. And third, I think people worrying about the property market and also consumption. I think for property market perspective, you probably can see the transaction volume in the top tier cities actually is picking back. And also the price perspective is getting stable. And for Chinese consumer perspective, the consumption is peaking back, but not in V shape. But as we know, the Chinese consumer, they saved around the US dollar 9 trillion since pandemic. That's about twice of UK's GDP. So if they have the confidence to spend, they have the money to spend. So we are seeing a gradual, more healthy recovery of the consumption market. And lastly, which is the most important one, is the company's fundamental. in our portfolio, we see the earning growth is coming back very strong. So, for example, the platform company, the technology platform companies in China, most of them actually they doubled their profitability since 2021, but actually their market cap has been halved. So I think that's the reason I explained is painting a picture of they supporting the growth. The growth is back, driven by the AI, driven by the advanced manufacturing, and also the domestic policy is turning back to support the growth.
Right. Okay, so it's been a great 12 months from a macroeconomic point of view. Stock selection is then the next bit, and you have outperformed the index quite handsomely over the last 12 months. So what's worked for you and your co-manager in stock selection?
Yeah, I think the most important question, like I mentioned, is growth coming back. Because as you know, the growth style in China has underperforming the value in the last few years. And also because our portfolio, we investing in a group of very innovative growth company, which is a private company. But in the last few years, if you look at the index, actually the SOEs outperforming the private company quite a bit. So I think that the whole turning point we have seen is the growth is coming back. That actually answer most of the questions why our portfolio is outperforming, because our portfolio is strongly biased into the growth innovative companies in China. And also, I think from the valuation perspective, most of the growth company in China is still trading about 45% discount compared to the global market. So we're thinking about in the next few years, if we see the growth of the whole economy coming back, and also we're carefully watching the fundamental of our companies. We don't want, it's just like you said, it's not the short-term rally. We want them to use AI, to use the innovative method to drive a long-term sustainable revenue growth.
Okay, that's great. So if you had to pick a company from your portfolio as it stands now that most typifies innovation and growth, give us an example.
Right, I probably will give two examples. I think the one example I think people probably heard about this story is about BYD. Which is a leading EV brand in China. So BYD, we bought the holding about a year ago, and we see actually this company is not going only to be a Chinese leader. So you probably read in the news that BYD has already overtaken Tesla in Europe as a new EV sales. So we're thinking about these global leaders now. They start from China, but they have a huge potential to expand into global market in the next 5 to 10 years. And that's a brand actually you have heard about. And the second one, I'm not quite sure you heard about the brand, but you definitely see a character called La Boo Boo, which is on the BBC News. So this is like a toy characters, and is a designer from Hong Kong designed that. But that is a company called PopMart, which is a Chinese younger consumer brand who is very good at the toys IP designing. And actually it's not only a China brand, it's a very popular brand in China, but now they are expanding to US, to the UK. I'm sure you see a lot of younger generation, or the younger ones, they are waiting outside their London Oxford Circus store. So this is actually the two stories we're seeing. China is not only the China player, and some of the brand actually they have strong potential to be the next generation of the global winners.
Right. Okay. Both really interesting examples. I own a BYD car, an MG, so, but I don't have kids who are young enough to buy that stuff, sadly. You emphasise long-term growth, company fundamentals. Is there never a clash when that comes up against political risk in the Chinese market, and how do you stay true to those fundamentals when political risk is always there in the background?
Yeah, Richard, to be very honest, that's a very fair question. And that actually is a question we ask ourselves regularly, because staying focused on long-term fundamentals in a market like China is not always easy. As you say, we have we sometimes we face a political uncertainty, which understandably makes the investor very nervous. But we found that actually with the right mindset and process, actually it's possible for us to stay grounded. I think at Bailey Gifford, we have been investing in China for over 30 years. The past experience told us sometimes the headlines can be very noisy, but what really drives the long-term return for our clients are company-specific factors. It's about innovation, it's about leadership and resilience. So in that perspective, our Shanghai-based research team plays a very important role in this because they help us, some of us based in Edinburgh, to look past the sentiment or the headline news in the Western market and focus on what's really driven China to change in the long-term trend. So that's one. And secondly, we also manage the risk very carefully. We don't normally predict the events in political side, but we always challenge ourselves to think what that going to change our company fundamental. So that's the reason, in our 10Q, which is 10 question research framework, the first question we ask for that company we bring into the portfolio is whether this company contribute to China and the global economy, culture, and society development. So we try to push ourselves to understand whether this company align with the long-term development of China and globally. And we actually also manage a diversified portfolio. So in China Trust, we can manage about 40 to 80 stocks, which means we can invest into different companies with different global potential and also drivers. So we know the political backdrop in China sometimes add a lot of complexity into the investment case, but we don't see a reason that we avoid it. We treat it something we should respect it, study it, and also accounted for. Because over time, what we have learned, we have seen the best companies in China, they're often able to adapt the challenge and strive in the long term, even in a very challenging, shifting economic environment.
Right, okay. Let's talk about innovation for a while. So the last few months we've seen DeepSeek AI take the world by storm. We've seen robots that run marathons and box each other. Where do you see the next wave of world-class Chinese innovative companies coming from?
Sure. I think DeepSeek is a really game-changing moment for China technology space. As you know, in the last few years, China facing a lot of challenge on the restriction on chips and semiconductor supply. So in quite a few years, I think there are lots of concerning about whether China can catch up in the AI space. So DeepSeek is one of the examples to prove China can produce the most advanced large language model in the world. And that's not only DeepSeek. I think Alibaba, ByteDance, Tencent, after DeepSeek, loads of technology companies in China, they quickly apply those DeepSeek model into their business because DeepSeek is much cheaper than the global models. And in China, we are keeping asking ourselves, who going to be the next wave of AI agent? So it can be, is that Tencent, is that ByteDance, is that Alibaba, or some new company coming from? So that actually make the Chinese innovation enlightening again after the DeepSeek moment. So that's one part. And secondly, that's for the semiconductor business. I know we having a challenge from the chips from NVIDIA, but in the longer term, China is very sure that they're going to have a self-sufficient situation in this. So we see some local champions coming out. For example, there's a company called Horizon Robotics, which we invested in the trust last year. It's overtaking NVIDIA as one of the solution for China in the chips for autonomous driving. So that's something we think in China, we'll probably see the next generation of the company coming from there. And the last one, I think it's really important, is a clean energy. So we talk about BYD, but in China, it's not only about BYD, it's about CATL, which is the largest EV battery and energy storage system provider. They have about 40% of the global market share, and they're helping the Chinese AI companies to build the next generation of the clean energy data center. So at this moment, I think energy cost in China is about 45% cheaper than the US. We think the long run of the technology rise globally is not only in AI, is AI plus robotics, is AI plus robotics plus clean energy. So that's three of the areas we're thinking probably we will see some very exciting next generation global winners from China.
Excellent. Okay, I'm going to put the case for people who don't believe in the China story, and you've got, on the one hand, you've got experienced investors who say it's uninvestable. They were saying this even before the current trade war blew up when President Trump came into office. And you also have some macroeconomists who say China is deglobalizing, the demographics are poor, and it's a top-down economic model. So two separate groups of people there, but obviously I'm guessing your answer to them would be the same story. What would you say to them?
Firstly, I clearly understand where the concerns coming from, but we think walking away from China is a mistake, because while China has the regulatory or geopolitical complexity, it's also the house of the world's most exciting growth stories, like I mentioned. And crucially, I take our China Trust portfolio as an example. I think more than 85% of our portfolio revenue generation actually still from China. So if we believe the growth story is still there, I think that's about Chinese consumption, that's about Chinese local market, has less relevance to the global market. And also, if some investor wants to avoiding China, means that they miss about a third of the world's best growth opportunity. And also, like I said, they are all trading at about 45 discount to the global market. So sometimes it's not only about the geopolitical risk, actually it's about opportunity cost, whether you want to bear the cost to miss that wave of companies from China.
Okay. You mentioned before about President Xi meeting the biggest private companies, and some skeptics might say that this is window dressing, and it's subordinate to his aims as leading the country in the style that he's led it. What makes you convinced that it's more than that, just window dressing?
Yeah, I just want to emphasize how important the private sector means to China, because I think most of the investors probably thinking about China is still a country driven by the SOEs, but it's not. Private company contributing around 65% of the GDP and 75% of the innovation, and also 80% of the urban jobs. So let's think twice how important that sector is for China growth. So we're watching the policy very closely in China and also in Canberra. Totally understand the people worrying about it can be window dressing, the pendulum can swim back very quickly. But what we have seen, the direction of travel is right. I think that, like I mentioned again, January meeting 2025 with a group of entrepreneurs is a very important public signal they're sending out. But we also see the real policy supporting private company. For example, the tax cut, the consumer subsidy to those e-commerce platform, and also more importantly, the new private economy protection law was passed in April 2025. So that makes a very formal commitment to protect and also promote the private economy in China. But again, things can change very quickly. So that's the reason we stay cautious. We stay very close to watch what the real policy coming out. So we've been talking to different founders. We've been talking to loads of private company in China to collect more balanced feedback.
Okay. Just turning back to the portfolio for a minute. So your active share in the portfolio is 65%, which is a bit low by Baillie Gifford standards. Some of them are much higher. How actively different is your portfolio to the index, and to a certain extent, does that matter when you're investing in China?
Yeah, actually, it is true that 65% of the active share may look low for Baillie Gifford strategies, especially if you look at some of our the most growthy global portfolios. But in context of China, we think active shares tells us only part of the story. So if you look at the benchmark we are talking about is the MSCI All China Index. So if you look into this index is heavily weighted towards to large state-owned enterprise in sectors like banking, financial, energy, and telecom. We did underweight those sector quite significantly in the past few years because, like I said, Baillie Gifford China Trust, we're looking for growth, innovative, and private company in China. So in that perspective, we hold more than probably nearly 90% of our portfolio is invested in those private, innovative, and growth companies, such like healthcare, artificial intelligence, EVs, consumer brands. So I think that's something we think the active share metrics probably didn't reflect the full part of the story. But that doesn't mean we avoid the SOE. We taking the company, each company very differently. We just want to make sure we're not trying to match the index by only investing in those SOEs, but we also would like to own some of the very innovative SOE companies in China as well.
Okay, and also you can invest up to 20% in unlisted names. What are you finding there? Can you give us an example of one of the unlisted companies you're most excited about?
Yeah, I'm sure if you look at the portfolio, we have one unlisted company in our portfolio, which is ByteDance, which is TikTok's parent company. We hold about 10% of ByteDance in our portfolio. We can invest up to 20%. I think that gives us a very strong advantage to research and invest and also hold those private companies for our shareholders, because you probably can tell some of the private companies in China, probably globally, the most exciting growth companies, they will stay private for longer because they are very cash generative. They don't really need to raise the money from the capital market, but they also do share buyback and dividends. So in that perspective, if we see this type of opportunity, we have the option to invest for our shareholders. But we've been, like you probably can tell, we've been very selective because 20% of those unlisted opportunity means we have less liquidity, and also the valuation method probably would not be as timely as a secondary market. So we only invest into the opportunity in the private markets. The risk reward can actually match this excitement for our investment cases.
Yeah, and ByteDance is obviously very exciting. Do you worry that they might be forced to sell TikTok?
Yeah, I think if you look at our valuation process, to be honest, when we value the upside of ByteDance, we didn't include the US market for the valuation at all. So as you know, ByteDance, they grow very excitingly in China and also Southeast Asia and Europe. So we still don't really know what President Trump administration will do with TikTok. But I think what we can control is when we're doing the valuation cases, we just don't be too much optimistic. We just take the US market out of the valuation.
Firstly, you've had investors who've been with you through thick and thin. For those that have stayed the course, what do you think has changed now that gives you genuine optimism about the future of the trust and the market?
Yeah, I think it has been a few very difficult years for our shareholders, especially the period from 2021 to 2024. But like I discussed with you, we have seen meaningful changes from domestic policies, from the government's attitude towards two private companies. So we are hoping for the growth story for China is coming back. And more importantly, we think the valuation in Chinese market still very attractive. And entry point to this market also is a critical moment for a shareholder to take consideration. And also the most encouraging sign, what we saw from last year, and from end of last year, we first time in the last few years we saw the international investors inflow to China. So we think that's a sustainable long-term recovery of the confidence and also the performance of this market. But we also stay cautious on some of the factors like a geopolitical risk, especially the relationship with US and China.
Right. And how would you assess the biggest opportunity and the biggest risk going forward for investing in China and your trust?
Yeah, I think our principle is very clear. We stay long term, but we also stay selective. We said we want to invest into the best group of growth story in China. That will, I think, eventually the return will compensate the risk we're taking to invest in this market. So that means we will raise a bar to select the company. We're not sitting there to only looking for kind of like slow return opportunity. We will fund the most exciting opportunities, giving us the long-term potential returns for our clients.
Okay. Right, we're going to come up with some viewers' questions. We've had quite a few come in. One is about, you mentioned EVs and BYD and how exciting that is. What about other forms of transport such as robo-taxis and vertical takeoff electric helicopters? They're making progress in the West, certainly robo-taxis. Is the same thing happening in China?
Yeah, I think we see, if you look at the EV, yes, China is leading the world about the electric vehicle, but that's not only about car. Because if you're thinking about the future generation of robotics, actually car is type of robotics. So we're thinking about autonomous driving will have the Apple moment in the next 2 to 3 years. That means we're excited to see in the next 3 to 5 years, China will have the L3, which is a hands-off solution for the city commute. So in our portfolio perspective, we have a holding called Horizon Robotics, which is a solution for the future autonomous driving in China. So they are the largest provider of the chips for autonomous driving solutions, as well as they providing the software service to those car brands in China. So they're not only doing the business in China, and they're thinking of the global expansion to Europe, because Volkswagen is one of their largest shareholders. So that's one very exciting story in our portfolio. And secondly, when you are talking about eVTOL markets, actually the portfolio holding called CATL, which is the battery company, but they are one of the largest shareholder to the Chinese Auto Flight, which is a leading eVTOL company. So in China, we think the way of like future will run as a future city will run like a computer. We probably have drones flying over, we have solar panels, we have battery to provide the energy, and we collect the data. And probably one day I can have the call with you, Richard, in the car, probably in the next 3 to 4 years.
Brilliant. Look forward to it. Another viewer has asked this question, and I think you touched on it. He says, Jensen Huang of NVIDIA fame says he thinks US sanctions on tech exports are actually helping and not hindering China, helping China forge ahead in innovation. Do you think that's the case?
Yeah, I think in the longer term, I'm more talking about in the next 5 to 10 years, that definitely will push China to have a self-sufficient solution, right? I think in Jensen's interview, there's another part he didn't really, he actually put another emphasis is in global market, there are more than half of the AI talents are actually Chinese. So that actually driven those Chinese to return to the country to build their own business. If the situation, if there are so many limitation, and also most importantly in China, I think the Chinese government is trying to let the different companies to cooperate together to bring this self-sufficient earlier than we were thinking about. So, for example, they are asking those foundry companies as you cannot burning too much capital. You have to work with your designers. You have to work with your different customers. So that means actually from this kind of like top down industrial policy will further speed up the self-sufficient journey in China. But we're still thinking about that probably will take 5 to 10 years. It's not like in the next a year or two, we'll probably see China will have a full solution for that.
Okay. Another question, this time about geopolitical risk. Says Linda, you talked about tensions with the US and how unpredictable that is. What about another unpredictable factor, which is China's relations with Taiwan? No one's going to ask you to predict if an invasion might happen or when, but how much does that play into your thinking about the way you construct the portfolio?
Yeah, I think that's a question we consistently get from the clients. But again, I'm not an expert talking about this type of like timing or things. But from someone like me, growing up in China, educate overseas, I would say it took China about 100 years to take Hong Kong back. So I think China probably will be much more patient and long-term thinking than the rest of the world thinking. And also, Taiwan is not something away from Chinese national. Probably, I mean, people thinking about Taiwan as part of like brother and sisters. It's blood. It's kind of like blood related. So we hope for peace, but again, I think we will closely watch how the geopolitical situation happens there, and we will try to think about how to manage that type of risk. Again, like we said, we manage the revenue only dense from the mainland, more than 85%. But what the extreme case happens is probably not only the bad things for China, right? If you're thinking about if that's an opportunity, if that's going to be the case, what happened to the U.S. market? What happened to the Southeast of Asia market? I think that's going to be a chain effect, not only for China. It will be the big impact to global.
Okay. Another question here. Why do you think the other story, if you like, in your tale of two stories, the view has grown up in the West, and particularly the media, that China faces a really challenging economic outlook?
I think it's quite interesting because I went back to China about like a month ago. I see many foreign visitors to China, especially in Shanghai. And as you know, actually, Chinese government they opened the visa exemption for quite a few of countries, including the countries from Europe. So I would say, if you have a chance to visit China, China is definitely not the place we read on social media in the Western countries 20 years ago. Is a country with very highly development infrastructure and friendly people, and also there are lots of beautiful places to visit. So I think seeing is believing. So if you have a chance, do visit China and put that into your holiday plan.
I'll bear that in mind. I'm going to wrap up with a couple of questions that are sort of take a different perspective on things and are sort of quite fun. Picking up on our discussion earlier, we've seen robots that fight, we've seen robots that run marathons. What's the next left field thing that we might see come out of China?
Yeah, I think the robotics industry in China is not only for something like entertainment robots we were seeing. So if you look at advanced manufacturing in China, the I think Chinese companies already apply this automation into their production space for quite some time. I was amazed to go to one of the factories of our holdings called Media, with all the robots in one of their factories. There's no human inside of it, and they can produce a wash machine only in 30 seconds. So it's all assembling together. So I think this is the reason why China has some advantage to lead the next wave of manufacturing globally. It's about the scale, it's about the innovation, and also it's about the cost, because China labor cost is no longer the cheapest in the world. But if automation, manufacturing technology, if the future of the robots coming in, I think China probably will keep this manufacturing advantage for quite some time.
Okay, and final question, and this reader spotted this story in the Financial Times yesterday, which I saw as well. It's about the rise of, I don't know whether you saw it as well, people drinking in illicit bars in Beijing because they're so much cheaper than licensed bars. And there's a serious point to this. What does this tell us about the state of the Chinese consumer if they're sort of down spending and going to places that are cheaper? Is this not a sort of phenomenon of a weak consumer?
Yeah, I think we need to link the consumption in China to the property market, because one of the key reasons the consumption has been weak in China is the dropping property price. Because in China, I think for the family wealth perspective, the property market probably accounts about 70% of the family wealth. So when you face this kind of uncertainty, when you face this type of challenge in your dropping property price, I think people became cautious to spend. But that's probably for the older generation, because they when they're feel nervous, they save. Like I said, they save a lot in the last 3 years. But when the sentiment coming back, when the property price stables, I think the people will keep more spending in the future. But the young generation is very different in China. They probably, because of the one-child policy, for example, like me, I have two sides of grandparents. I have my parents. Probably, I don't really need to concern too much about the property in China. So or like someone younger than me, they are very willing to spend on the experience. Probably, if you look at the ticket box for concert, for the like shows, actually the volume picking up a lot. So that means the next generation of consumers in China that not only put the focus on property, buying some fixed assets, they're enjoying their life. For example, the boss you mentioned about the traveling industry, they want to pay more to the experience. And one of the very interesting story coming out is Luckin Coffee. People probably not heard about that too much in global market, but in China, that's a younger generation consumer coffee brand. They overtook Starbucks by the number of stores open in China. And so in terms of that, we're excited to see the next generation of consumer brands who can meet the demand, meet the expectation of the next generation younger consumer. Popma is one of the example. And I think we need to talk to those global brands who are really losing market share in China. What's going on? Is your product meeting the expectation of the younger generation, or actually you need to spend more R&D into this one of the largest consumer market globally?
Great. On that optimistic note, we're going to wrap up, and that's all we've got time for, I'm afraid. So, Linda, thank you so much. I think it's been an absolutely fascinating discussion today. And thank you to everybody out there for all your questions. We do have more sessions like this coming up, so please do keep an eye out for those if you found today's useful. And until next time, goodbye.